I think the fight against inflation it's not won yet, but it's further along than the market gives it credit for. Now, you put yourself in Powell's shoes. He wants to ease. And it's not necessarily because they want to, prop up the markets and be the Santa Claus that the Fed always is. It's because they're scared to death that Fed funds, that interest rates are too high. And, we've talked about this for 2 years, that the lag effect is going to just come up out of nowhere and crush the economy. And it is starting to have an effect.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart, welcoming you back here at the end of another week for another weekly market recap. This time featuring my good friend, Michael Lebowitz. Hey, Michael, how you doing?
I'm doing great, Adam. Thanks for having me.
Thanks. Well, folks, Lance is the week off. You may remember he is vacationing in Greece this week. And Michael, it seems like he dodged a bullet because Houston got hit by Hurricane Beryl, and I think a lot of people there are still without power. And it's like crazy hot there right now.
Yeah, pretty much everyone in my office is without power still. Some of them have generators, so they're doing okay. Our office is working, everything's functional, but a lot of them are, no air conditioning, and it's getting close to 100 degrees. So,
Oh, it sounds miserable. Yeah, I talked to one or two guys there from RIA this week, and they were pretty much camped out in the office. They said it's
yeah,
much pleasant there than being at home.
yeah, it's nice being high and dry on the East Coast.
Yeah,
A little
congrats.
hot, but dry.
Yeah, and I'm sure Lance is sending all sorts of snarky comments from the beaches of Greece to these
As
guys.
you would expect.
As you would expect. All right. Well, look, thank you so much for stepping in to fill Lance's shoes. It's always great when we get you instead of that guy. And just full disclosure for folks, you see me not in my normal recording studio here. I am on the road this week. I am going to be going to my father's memorial service. You may remember he passed away around Christmas time last year. The family's actually having the celebration of life now. And in a cruel twist of fate, Michael agreed a week ago to step in for Lance while Lance was going to be out. And then he himself had to go attend a funeral, which is why he is not in his normal office as well. So anyways, I appreciate you being so flexible and doing this in the midst, the things that you've got going on, Michael.
Of course.
All right. Well, look, folks, this will largely or very likely be a lot shorter than normal given Michael's and my schedules and commitments here. But we did want to make sure that we got you an update on what's going on in the markets, and we'll hit a few other topics if we have time. So, Michael, why don't we? I guess we'll get in a moment to what the S&P is up to. But maybe let's sort of talk about what was new this week. And one of the big things we got was the new CPI data, the new inflation data. We also had Chairman Powell testifying before Congress this week as well. So just I'll throw the facts out there and then I'll let you opine in any way you want to. But the CPI actually came down a fair amount. The headline CPI, it dropped from 3.3 year over year last month to now just 3.0 this month. Seems that was driven a lot by a drop in the cost of gas and also falling auto prices, both new and used. Core CPI actually increased month over month, just a little bit, about 0.1% from May to June. And that brought core CPI down, but not nearly as much as the headline CPI. Core CPI went from 3.4 to 3.3%. But the market is looking at this as favorable news. And of course, in the market's mindset, the faster inflation gets down, the faster that Jerome Powell can start deploying the rate cuts that he's been saying since December that he'd like to be able to do. He's been along saying, hey, I want to see more evidence that inflation's heading down to our target 2% level. This week, even before the new inflation data came out, Powell in his testimony to Congress said, hey, we're pretty happy about what we're seeing. He basically said, we are seeing the disinflationary trend that we've been wanting to see, that is giving us confidence we're going to get down to our 2% eventually. Of course, the market, as soon as he mentioned that, the markets went off to the races saying, wow, rate cuts sooner, maybe even in July. We started to get that speculation. Then Powell has been quick to then chime in with what he's been saying all along, which is, well, wait a minute, we're going to really have to see a lot of good evidence before I'm willing to actually start making cuts. So he's trying to sort of tell the markets, hey, guys, slow your roll a little bit. But that doesn't prevent Wall Street from doing what it does best, which is always trying to expect Christmas tomorrow.
Right.
So, Michael, that's sort of the facts of the situation. What are your interpretations here?
So on CPI, there's one number that I think is probably the most important number to watch, and it's CPI less shelter. And that's basically the other 60% of CPI. 40% of CPI is just shelter, and that's rents and implied rents. And it's basically, what actual rents, like renting an apartment or a house or whatever, and then rents that they imply from the cost of houses and surveys, et cetera. That number was 1.8% year over year. That to me is much more realistic. That's the real rate of inflation, which is below the 2% target. And the reason I say that is because shelter, we've talked about this before, Lance and I talk about it all the time. Shelter's about 40% of the number, and it significantly lags what's really going on in the real world. And there's a number of reasons for that, but the primary reason is that they're asking people what their rent is. So if my rent just came up and I renewed yesterday, I'll tell them the market rate because I just renewed at the market rate. But if I renewed my rent 6 months ago and they asked me what my rent is, it's what it was 6 months ago. So the CPI rent index lags greatly, but every other corporate type rent index is telling you that rents are flat. Some are slightly higher, a decent number are actually lower. So when you strip out the 5% or 5.1% year over year inflation coming from shelter, what we get is CPI less shelter is 1.8%. And look, we can talk about used cars are going down, insurance is going up. There's all kinds of contributions from different goods that are going up and down. But I think the fight against inflation it's not won yet, but it's further along than the market gives it credit for. Now, you put yourself in Powell's shoes. He wants to ease. And it's not necessarily because they want to, prop up the markets and be the Santa Claus that the Fed always is. It's because they're scared to death that Fed funds, that interest rates are too high. And, we've talked about this for 2 years, that the lag effect is going to just come up out of nowhere and crush the economy. And it is starting to have an effect. And here's the really interesting thing. Headline inflation went year over year from 3.3 to 3%. The Fed looks at inflation, and most economists do on a real basis, not inflation, at interest rates and Fed funds on a real basis. So after inflation. So if you think about what just happened yesterday, Fed funds are still the same at between 5.25% and 5.5%, but inflation just went from 3.3 to 3. The Fed essentially tightened rates yesterday. I mean, they didn't tighten, but the level of real rates rose by roughly 0.30%, 30 basis points. So the Fed is, if anything, they want to ease, and they're scared of rekindling inflation fears because inflation expectations can create inflation. So they're kind of walking this tightrope, and it's got to be very difficult because they would love to ease. And and then you have an election, and they don't want to be seen as trying to help Biden or help the Democrats by easing right in front of the election. But broadly speaking, the inflation data was very good. And we've seen that for the last couple months now. And it's not just CPI and PCE, the government data. We've seen it in the surveys. the manufacturing surveys, the service sector surveys, University of Michigan inflation expectations have started coming down a little. So I think what we're seeing is that disinflationary trend, not deflationary, but disinflationary, where the rate of price growth is declining, but it's still increasing, but just coming down increasing at a lesser rate. We're seeing that disinflation trend reemerge after being sticky for about 6 or 9 months.
Okay. You mentioned a lot of important things there. So I'm going to pull up a chart here that Michael Pinto brought up in an interview I recorded with him, that folks, if you're watching this video the day it comes out, which would be a Saturday, the chart I'm talking about is going to be in the next day's interview. Michael's interview will release on Sunday. So I'll just mention this briefly, and then in tomorrow's video, Michael Pinto really gets into this in a lot more detail. But here is a trend of the real Fed funds rates. And you'll see here, since the turn of the millennium, we've had this series of real Fed funds rate. On a real basis, the Fed funds rate is positive. But as you were saying, Michael, that sort of acts as a tightener on the economy. And then so after the period of positive real Fed funds rates, we then fall into recession, and then usually the Fed then has to basically, cut and bring us to an era of negative real Fed funds rates, and then we kind of rinse, wash, and repeat. Although we've had this prolonged period between the great global financial crisis and COVID, where we had virtually no positive real interest rates, and a lot of people had said that was because it was because of reserve policy and all sorts of things, but the economy was becoming so leveraged it couldn't really sustain higher real rates. Well, now here you see at the end we've reverted back to positive real rates as the Fed has gone through its tightening regime. And you just said, even with the last month's data that we just got, that's increasing these real interest rates again, weighing even more on the economy. So again, for guys like you and I who talk about the lag effect, that's essentially what this chart says, is real interest rates go positive until the lag effect starts pulling the economy into recession, and then the Fed just has to revert back. Does it indeed look like we're seeing history about to repeat here?
This has been my bullish bond thesis for the last, we started talking about this last October, last fall, late summer. This is my thesis. It's that Fed funds are too high for what the economy can handle. And not just Fed funds, interest rates, mortgage rates, all corporate loans. They're too high for what the economy can handle. And you may be thinking, what do you mean too high? When I was, 20 years ago, I took out an 8% mortgage, and the difference between now and 20, 30, 40, 50 years ago is the amount of debt, specifically unproductive debt, out there is much greater today than it was. So you have this big headwind to growth because we have to take a lot of money and use it towards servicing that debt instead of investing into our economy. So in order to make that sustainable, we need lower and lower interest rates. And occasionally we get into periods of faster growth. Economics, the economy is cyclical, goes up and down, but we get into periods of stronger growth like we've seen for the last couple of years. And regardless of why it happened, we know it happened because of all the stimulus, the pandemic, and just a lot of crazy things that happened during that period, both on the fiscal side, the monetary side, as well as our consumer behaviors. We all contributed to it as well. And the Fed had no choice but to raise rates, but they raised them too far. Maybe they didn't raise them too far, but they're too high now to sustain the economy of pre-COVID. So now, as all that stimulus is getting washed out of the system rapidly, we're going back to that, in my opinion, we're going back to the pre-2020 economy. Yet we have rates that are extremely high, especially on a real basis. And that graph, I think you can pretty much see what's going to happen next. Real Fed funds are going to go negative because the Fed's going to have to prop up all that old debt plus all the new debt That remember that the government just added a ton of debt to the economy. And a lot of it was unproductive debt. And that's going to have to be, so this is fiscal dominance. I just wrote about this topic, that the Fed has to be out there, and interest rate policy is not just about the current economy. It's about servicing all the old debt at the federal level, but also to a lesser degree, for consumers and corporations.
So I'm just going to pull up another chart here. Your expectation is the Fed is going to have to start cutting at some point soon because the economy is going to start cooling faster than it wants, right?
Mm-hmm.
And I've mentioned this many times before, but it's just worth showing this visual once again for a few seconds. This is the playbook. This is the pattern of history, right?
Mm-hmm.
If you look at this chart, it is basically a tale of whenever the Fed does hike interest rates, it hikes them, they plateau for a bit, and then the Fed realizes it's kept them too high for too long, and we hit recession, and then the Fed has to start cutting rates dramatically. Now, it's not really, many might say, okay, it's not really fair to look at 2019, 2020, because COVID was a black swan in the middle of nowhere. But if we look before the global financial crisis, if we look before the dot-com crisis, we look before the recession in the early 90s, this is the playbook. Rates rise, the Fed then realizes, it hangs out, says, okay, I think we're done. And then it says, oh my gosh, wait a minute, the lag effects starting to whack the economy. This is happening much faster than we want. We got to start cutting like crazy. And this is one of those situations where they take the escalator up, but then the elevator down. That's pretty much what you're expecting to happen from here, right?
Yeah, and if you were to put GDP, the rate of growth of GDP over this graph, you'd see it following the same path. If you put inflation over this, you'd see it follows the same path. And that's what that path is the foundation of our economy. Is just, first of all, we're a very mature economy. So growing a mature economy, you tend to get slower growth. That's just the way it is. But now we have these massive overhangs of debt that also just weigh on the economy. Our demographics are slowly turning from a big positive to a negative. And productivity growth has been still growing, but at a decline, at a lesser rate for the last 40 years. And that's the economy. And when you apply high interest rates, you're gonna slow down an economy that's dependent on debt. That's just the way it is. And I think we've been fooled in the last 3 or 4 years to think this time is different. Something has changed in the economy. And behind my bond thesis is that nothing's changed in the economy. We have AI, and that may on the margin give us some more productivity, and there'll certainly be some benefits, but there's some negatives as well. And I think at the end of the day, we're quickly normal. Everyone uses the word normalize. Well, normalize implies that we're going back to the way things were, right? That's pretty much a definition of normalizing, right? The way things were was that the economic growth trend was slowly declining. Inflation tended to run below. The Fed was always begging for more inflation. Prior to 2020, the Fed would beg. They want a little more inflation. They want to get it up to 2%. Can't tell you how many times the Fed said that. And I think that's where we're going. It doesn't mean we're going to have a recession or a depression or anything. We're just normalizing. And if you think about what normalizing means, we're getting inflation down to 2% or lower. And right now, Fed funds are 5.25%. That means Fed funds have to come down significantly. And bond yields in general have to come down significantly.
Okay, and that's obviously a big part of your and Lance's bond thesis.
And it's been my thesis. And, I came on here, rah, go bonds, 6-9 months ago, whatever that was. And, bond yields have come down a little since then, but inflation was sticky, right? We kept hearing that word, inflation was sticky. And a lot of people were saying, oh, inflation's going to pop back up. I kept seeing that graph from Apollo that compares the recent inflation activity to the 1970s and 80s. And it couldn't be further from the truth how different this era is than that era for so many different reasons. And look, at the end of the day, I just think inflation is going back to where it was, and recession, no recession, real Fed funds are just way too high. And bond yields are too high. We can't, our real estate markets can't afford 7% mortgages. You're seeing it, the whole market is dried up. You know, there are no transactions. There's a few here and there, but there's just nothing going on. And it's just an economy so dependent on debt, can't have high interest rates.
Okay. And it is interesting when the Fed started hiking, a lot of folks that I would interview, including Lance, were saying, oh man, well, they'll never get above 3% because the economy just can't handle it, right?
Mm-hmm.
And I think most people have been surprised at how quote unquote resilient the economy has been, right? I mean, everybody was expecting a recession coming into 2023, never happened. In fact, economy grew quite robustly in 2023. The stock market caught on fire with the whole AI trade. And that has largely continued into 2024, although economic growth has really started to slow. I think what you're saying, and I got to say, I agree. I try not to. I'll opine as I can in these interviews, but this show isn't Adam Taggart's opinions; it's the opinions of the guest experts here. But one of the bells I have rung an awful lot has been the lag effect. And I think you're making the argument, which I agree with, that it has merely been delayed and delayed through a number of different factors. Probably right near the top of the list, I think, has been global liquidity. There's still been so much sort of that's been pumped into the system through the draining of the reverse repo program and the Congress's deficit spending and a number of other things that have been going on, that it has pushed the arrival of the lag effect off so long that most people have said, hey, it hasn't snowed for a while, so I guess winter's not coming this year, right?
Right.
The answer is just it's still coming, it's just delayed. And maybe the argument might become, hey, the lag effect may actually now be even bigger than it otherwise would have been because it had been held at bay, almost like a dam, right? And now it's going to be more destructive to the downside than it otherwise normally would have been. Not necessarily saying that, but I'm saying that could be a possibility here. Okay, so a couple other quick things. And I'm glad you brought the bond part in, because I was going to ask you about that, and I might still ask you one or two more questions related to that. But I had a lot of people on of late who have been trying to climb in the head of the Fed and trying to think with see what the Fed is thinking. And while we don't know with certainty, if you look at Powell's commentary, he does sound increasingly worried, right? And I know you said you think he's really worried that the lag effect is going to come, but his hands have been tied because of inflation, and he's dying to cut as soon as he can, but he's been hamstrung. In his recent commentary over the past week, he said a couple of things. He said, hey, inflation is now not the only risk that we are paying attention to at the Fed. And he's mentioned two things. One of which is he said that the labor market is, quote, cooling really significantly. And he has talked forever about how hot the labor market is and how the Fed wants to cool that off to quote normalize it, like you said, right? And for a long time was talking about how there's way more job openings than there are applicants. And I spent a lot of time talking with people on this channel, Lance especially, about how increasingly the labor market data has just been harder and harder to swallow. So there's an argument that the Fed has been looking at or using data that is both lagging and maybe faulty. But it seems like Powell is beginning to get the memo on that. Like, hey, maybe this labor market's really not as solid as we thought it was. But of course, the longer you keep interest rates this high, you would expect eventually the labor market would start to respond to that. But anyways, in his past couple of press conferences that he's done after the FOMC meetings over the past couple of months, he has started injecting like, hey, we're going to cut rates if and when we see that we're confident we're going to hit 2%, or if we start seeing some things in the job market that start to worry us. And I was wondering if he wasn't trying to sort of, set an advanced expectation so that if he ends up having to cut, even if inflation's not down at 2% yet, he can say, well, that's because of the weakness in the labor market that I've been telling you if I saw I was going to start.
Right. Right.
So there's that. And I'll say one more thing and then I'll let you respond. I think the bigger thing that he's worried about, which has been covered a little bit, but not a lot, is he has also said in his testimony that the US economy is entering a, quote, critical period because the deficit levels are, quote, unsustainable. So, I think he is maybe beginning to get a little bit more vocal than he has been about the fact that you've got the Fed, which has been really trying to tighten things and cool things off and bring inflation down. So that's the monetary side of the house. But if you look at the fiscal side, we've been doing nothing but just trying to, spike the punch bowl with more and more alcohol, right? And I'm pretty sure that is not what Powell ultimately would like to have happen, because it kind of undoes a lot of the tightening that he's trying to do. I actually just interviewed Anna Wong, who is the chief economist at Bloomberg Economics, but she used to work at the Fed. She used to be an advisor on the Presidential Council of Advisors, economic advisors, and she also used to work at the Treasury. So she kind of knows, this whole policy world. And I asked her point blank, are the Fed and the Treasury, are they really at odds with each other policy-wise right now? Or is this part of some more complicated, coordinated dance they're doing where they're handing a easing baton back and forth to each other? And she said, no, it's the former. They're not coordinated. The Fed's got to be pretty frustrated with the fiscal policy at this point. So anyways, big picture point is that I think Powell is beginning to say, hey, look, guys, I can only do so much with the monetary, levers that I have. If we keep going down this fiscal path, it's going to end badly for all of us.
Right. So you touched on a lot there. So if I miss some of it, just come back to me. But you started, and this is very important, the data. Like, we keep hearing the data's garbage. The data's garbage, especially with the labor data. We're seeing rises of 2, 3, 400,000 jobs on a monthly basis. And then if you dig into the data, just at the surface, you see that full-time jobs are declining, part-time jobs are rising, hours worked are declining. There's the household survey is negative. And Chairman Powell has talked about that for a couple months now, that the data is faulty, and they know it. And it's not, I don't think the data is rigged. I just think that the surveys they use and the way they get the data is poor. It's antiquated. And they're left with what they have. And the Fed has recognized that both the CPI data, he's talked about shelter now for 3 or 4 months, that it's artificially high because the shelter prices are lagging what's going on in the real world by over a year now. So the Fed knows what the Fed, look, they have 500 or so PhD economists. They know what's going on with the economy with inflation. But like you said, they have to kind of walk this public appearance that they're fighting inflation and that's their goal, and they're going to get inflation out of 2%. And the last thing they want to do is get inflation expectations to rise, which would cause bond yields to rise and could really accelerate any downside in the economy and make it very dangerous for them. They're trying to balance the economy while they're keeping interest rates too high, in my opinion. So, it's a really tough game they're playing. And then the fiscal deficit side is very important. If you look at the deficit, one of the reasons that it's so high the last couple of years is the interest expense. You can add about 500 billion a year to the deficit just because of the interest rates popping up from 2-3% to where they are now. So if rates come, it's kind of circular. If he were to just cut rates immediately and the whole bond curve would go, Treasury yield curve would go down back to, let's just say 2%, the average cost of debt for the government would start slowly falling. And you can save half a trillion, roughly $500 billion off the deficit just because of interest rates. Deficit's still too high even without it, but it brings it back to normal. Keep in mind, the economy is much bigger today than it was in 2019. So everyone likes to throw these absolute numbers about the amount of debt outstanding, and it's massive. I'm up there on that list of people yelling that this is a problem. But as a percentage of GDP, it's been relatively flatlining for the last couple of years. And again, it's GDP, just like our salaries. That's what pays the bills. So if our interest rates are going up, but our salaries are going up, it's not quite the same as just saying, oh, our debts are going up. You have to kind of look at it in full context. And I'm not making excuses for the government. I think it's pathetic, and I think there's some massive long-term negative implications for what they're doing. But I don't think that the debt problem is as bad as advertised by a lot of people.
Let me ask you this: is it that the debt problem isn't as bad as advertised, or it's as bad as advertised? It's just not as imminent a threat as some.
It's not an imminent threat. Look, there's plenty of firepower. We know the Fed can do QE. There's other things they have kind of up their sleeve that they could do. They can change the capital requirements pretty easily and basically create a program where banks could buy treasuries and basically not have to count it against their capital, and they can basically book risk-free profit margins, borrowing from some sort of BTFP program that they came out with a year or two ago to help the regional banks. So there's plenty of things, if they wanted to, the Fed could do. But again, the best thing they can do is lower interest rates, because you're going to strip up to 500 trillion off the deficit just from that. But it doesn't seem like government is going to take charge and lower the deficit. And in my opinion, it doesn't matter who's president next. Those deficits are not going back to normal, so to speak.
Yeah, it seems like that is just the standard operating playbook at this point in time. And this is a rant for a different day. I've had it many times on this channel anyways, but we have a political base, our current cohort of politicians. Their skill set is knowing how to divide an ever-growing pie, right? And so if you can't grow the pie organically, you grow it through deficit spending. They do not know how to ration flat growth or shrinking pie scenario, and they probably never will, right?
That ship has sailed.
That ship has sailed, and we will probably be in that scenario at some point in time, but it's just going to require that we get rid of the old guard and put in a new guard then.
And this is the problem with the Fed. They basically allow them to do it. They make it easy for them to do. If interest rates would stay up here, eventually it would be a real problem for the Treasury. They would just have to figure out, the debt would be harder and harder to place, because that interest expense would keep rising as old debt at lower interest rates matures and has to be reissued at higher interest rates. So it's kind of a ticking time bomb. But the Fed has stood by the Treasury for years and years and helped them with lower interest rates. Again, you or I could borrow $1 zillion at a zero interest rate and be perfectly fine, right? Not go bankrupt. So it's all about the interest rate, and that's really important to think about. It's not necessarily the amount of debt, again, because we could take on $1 trillion in debt at a zero interest rate. It's about the interest rate, and that's what the Fed can basically, try to manipulate.
Yeah, and a couple of things. One, just to reiterate a point that Lance makes really often. So I don't think you're trying to be dismissive of the long-term threat of our debt trajectory. I think, like me and many others, and correct me if I'm wrong, the current trajectory we're on, if we don't change our behavior for the better, ends in a currency crisis at some point in time, right? You just have so much debt, you really get forced into a corner eventually of you either got to let it default, which is just ridiculously painful, and no politician, at least of the type that we have, will willingly preside over that, or you service it nominally by basically, killing the purchasing power of the currency by just printing more and more currency to pay it.
Or you just lower interest rates to zero.
Sure.
And there's implications with that. I'm not saying that's favorable, but all of basically everything you're saying argues that the economy is going to be weaker and weaker and weaker, that our growth rate is going to just keep declining and following that trend because we have this burden of the debt. And you're right, at some point, this all crashes. I think, in my opinion, it's not next year and it's not the year after, it's down the road.
That's the point I'm making here, which Lance makes much more often and eloquently than I, which is if you're a regular investor looking at the debt situation, you are right to be concerned. And I would say right to be very concerned about this, but it is not the type of risk, or highly likely not the type of risk that you want to sort of position for, like this is going to happen tomorrow or in the next couple of months, because a lot of people who get spooked by, understandably by the rightful threat that this poses, they just get all wound up emotionally and say, well, I got to protect against this tomorrow. Right. They change all their investment allocations and oftentimes, get super conservative and defensive. And then the market continues doing what it's doing for another decade or several decades, right? And you get crushed by the loss of purchasing power over time, right? So just trying to say, manage your emotions on this one, folks. All right, so something else you were saying that I just think is worth noting is you said that the Fed, is highly likely getting increasingly concerned about things, but at the same time, it has to project confidence, because if it didn't, if it said, hey, look, we're really worried about all these types of things that might throw the economy into a recession soon, or just might make our jobs a lot harder, then the bond market would say, oh, okay, well, man, that makes me nervous. I want to be compensated more for this risk. And it would start driving yields on the long end up, right? So it is a tricky dance because the Fed does have these kind of crude tools, and it's got to manage sentiment as well as it's trying to land the plane here, right?
Right. It's a really difficult situation. It's, he's walking a tightrope. There's problems on both sides, and he has to stay on that straight and narrow. I think he does want to lower rates, but doesn't want to spook the inflation markets, the bond markets. And he also doesn't want to cut rates. He doesn't want to raise rates. That's going to create problems. And he doesn't want to cut because of the bond market and inflation expectations. So he's, I think ideally he would like to cut 25, wait 3 months, maybe cut another 25, and portray this sense that we're just going to normalize Fed funds, normalize interest rate policy as the economy normalizes. Sounds great in theory, but what we find is, if you look at a graph of Fed funds, they go up, they stabilize for a short or medium period, and they go way down quickly. Right? Stairs up, escalator, elevator down. That's what has happened. It's very rare where, I think it happened in 95. It's very rare where they cut a couple times and then it's like, okay, we're good. We stabilized the plane, we brought it down from a lower from a higher altitude to a lower altitude, and we're stable. We avoided that thunderstorm up there and now we're good. And we're just going to fly at 15,000 feet or, whatever. Normally you're coming down for a landing. Whether it's soft and, or hard, that's debatable, but it's not common for the Fed to lower rates slightly.
Right. Well, so we've got a stock market that is still priced for a no landing, right? And it's hyping itself up on hey, rate cuts coming soon at some point, right? And of course, that's been the market's game this whole hiking cycle, trying to front run the Fed. But something I want to note, and I mentioned this briefly last week with Lance, is what we as investors have to be cautious about is the market generally likes to try to find stasis. And then, it's volatility is greatest when there's a sentiment shift, I guess is what I'm saying. And so if you get comfortable in the market stasis, one of the things you have to be doing as an investor is saying, okay, how likely is this stasis to continue, or are there curveballs out there that could knock it out of its stability? And of course, Lance is right, which is, I mean, if we're talking about like a crisis in the market, like a big destabilizing event, it's going to be something that's probably not on our radars, right? It's going to be, that's the definition of a black swan. It's something that you're just thinking about, right? But I think there are some gray swans or white swans, where you still could, they're candidates for a pretty dramatic shift in consensus. And the analog I want to use, so we're talking about this jobs data, right? Where folks like us have been complaining about it for a year and a half. The Fed has now been making some comments about it, but much more mild, much more mild language than we've been using, right? But the market is still saying, oh, yeah, but it's the data we have, and we're all going to just continue using it, right? And yeah, there's some people increasingly questioning, the birth death model and how much that's adding. And if we look at the quarterly, the QECW, the quarterly estimate of
I think the
wages,
Philly Fed, right?
Yeah. QCEW, quarterly census of earnings and wages. That suggests that jobs may be overestimated by the tune of like 100,000 a month or something like that. So we're kind of hearing that chatter still on the periphery, right? But I think there's a danger that at some point, the labor market could really roll over. And there's lots of other signs that we look at that suggest the labor market is way weaker than the official data that we're seeing. And we could tip into it like, oh gosh, wait a minute, this data, all of a sudden it's common knowledge, right? Hey, we've been looking at this gauge as a key gauge of the economy. Like it's like a pilot saying, hey, I've been looking at this altimeter and I'm realizing it's actually 50% off, right? And the plane is flying much closer to the mountains than we thought it was, right? And where I'm going with this is people be like, yeah, well, maybe that'll happen and maybe it won't. And that's true. But my point is, it's just if it happens, it could happen quickly and therefore set off a repricing cascade. And an example of this that's happened recently in terms of sentiment shift has been, and this is not a partisan comment, but it's been the perception of President Biden, right? I mean, right up until the debate with Trump, the conventional, position and understanding was, yeah, he's a bit older, he's maybe a little bit slower now, but man, this guy is still all there and he's doing great. And his advisors are saying, I just met with him yesterday, he's sharper than ever, whatever. But no problem, no problem, no problem. And then literally, minute one after the debate, the Democratic machine started saying, whoa, wait a minute, this is worse than we thought. And we got to start talking about alternative candidates and all this stuff, right? I mean, it was a massive sentiment shift from comfort to discomfort, right? And I just see certain contenders like the jobs data out there as a contender for that, where everybody's on board. And then one day we see something and then we wake up and everybody just says, wait a minute, this data is super broken. We can't trust it. And then the market has to say, well, look, I need to be compensated better for this risk. And then things start coming down.
Right. So what you just talked about reminds me of this recent Ben Hunt article on common knowledge. And it's a great article, and I'm going to butcher it here. But what he's basically saying is we can all think things, but it's not common knowledge until we know that we all think the same thing. And it's kind of hard to describe, but that was the Biden.
It's sort of like the emperor's new clothes is a great analogy for what he's talking about.
Yeah.
Everybody might be thinking it in their mind, but until it's actually out there in the public that, hey, other people think like I do.
Oh, other people are thinking the same thing now. And that's what happened with Biden at the debate. We all knew there was something off. We've seen the videos, where he wanders the wrong way or, little things. But you always kind of questioned, is it just context? Is it AI? I mean, especially, people that like Biden, a lot of that stuff was easy to say, oh, he just walked the wrong way or he but we saw it on a debate. It was painfully obvious. And then everyone, especially his supporters in the media, turned against him. And that's when it became common knowledge that he has real issues. And he keeps falling all over himself. Yesterday with Vice President Trump and his comment about introducing Zelensky as Putin. And so this common knowledge is just increasing, but the same thing can happen in the labor market where you get a minus 400,000 print because the data, what the BLS is doing kind of catches up. It's glitchy, for lack of a better word, and you get a couple months of some really bad data. And the problem with unemployment is extremely important, because when we fear that we could lose our job, or that we're not going to get a raise, or that we see our colleague get fired, or we see a neighbor get fired, you start holding back on spending. And that's why labor is so important, is because it can kind of change your opinion really quickly. And you may just say, let's just not go to dinner this week, go out to dinner this week or tonight or whatever. Instead of buying that $60,000 car, let's buy the $40,000 car. One of my 2008, I don't know if I've shared this story, but it's worth sharing again. 2008, we're sitting at a restaurant. This is when things were going pretty bad already. And it was pretty full, but there were a couple seats empty. And my wife made a comment. I said, it's doing pretty well considering the economy. And she said, there are some empty seats. There never used to be empty seats. And kind of the gist of it was that the restaurant was running at, let's say, 90 or 95% of what it typically ran at. And that looks fine on the appearance. But if our economy drops 5%, so if that restaurant is the economy and there's a couple tables empty and it's running 5% below average, that's a deep recession. So, the economy functions, and it's going to function during a deep recession or boom time. And it's hard to notice by looking, but when you start sensing and hearing of people being laid off, or no raises or no bonuses this year, or something with your neighbor, you pull back. And that pullback process can happen quickly. And if we're all thinking this with the labor market, which I don't think most people are that aren't paying attention, we pay very close attention to, and most people you interview are digging through these BLS numbers and trying to figure out what they're saying. But when it becomes more common knowledge among everyone else, it can result in a very quick pullback in consumption. And personal consumption is 70% of the economy. And it can happen pretty quickly, as we've seen. And that's why Fed funds take the stairs up and the elevator down, because the Fed has to react really quickly to that. And unlike previous times, we are well above where we should be already. So they're going to have to take the elevator down 2 floors before they even get to where they probably should have been, and then take it down to the basement.
All right. So this is, you're underscoring why I keep watching the employment data so closely, and folks that watch this channel frequently know about Michael Kantorowicz and his HOPE framework, and the E there in HOPE is employment, and that is sort of the last bulwark between the economy and recession, right? But I will say, and this is more anecdotal, but we've been hearing forever about how strong the jobs market has been, and how there are all these openings, for versus applicants. But I mean, for a good year plus, if you talk to job seekers, you hear a very different story. You hear a story of, these companies have these jobs, but it doesn't seem that they're actually hiring for them. And I've actually heard from hiring managers who have admitted a lot of these jobs are just for optics, right? Just to protect budgets or make it look like the company's doing well. And so you hear from job seekers that it's actually been a really hard time to get a job. So, we're increasingly kind of in this, who are you going to believe, me or your lying eyes scenario, right? And the analogy I've used many times is, you can only for so long have the weatherman on the TV channel telling you it's a sunny day when you look outside and see the rain before eventually you're like, look, that guy doesn't know what he's talking about, right? And we're not there yet, but we have seen a lot more layoffs in the past year than we saw in previous years. Warn notices this year have exploded. And so at some point in time, people just might see enough companies switching to job cuts around them. And one of the things we didn't mention, we were talking about the lag effect of these higher rates, is the re-rating of debt on the corporate side that's going to be happening over the next 2 years. So there's a lot of things there that could convince companies, hey, it's time to start jettisoning that labor that you've been hoarding for the past several years. And if people start seeing that, to your point, that's when they start going into self-protection mode. Okay, wait a minute, I'm getting really worried about the stability of my income. I'm going to start putting more of that away or reducing my cost footprint, and that can really have big economic impacts.
Exactly. And labor hoarding is a big deal too. And it's easy for a company to hoard unproductive labor when they're making good profits, but when their profits start coming down, they're not going to be labor hoarding anymore. And that's, I think, where you get some big problems with the labor force, and job numbers turn really sour.
All right, so let me get to this this article here, which, just let me pull it up here for the headline, which is stock fragility is the highest on record. So, everyone's been hearing about NVIDIA and how much the stock markets are being driven by fewer and fewer companies. And I can't remember off the top of my head how many how much of the S&P's gains this year are just simply attributable to NVIDIA, but it's some stupid amount. So, all of this seems to be, all these plates we're talking about, these spinning plates, seem to be getting held up by fewer and fewer sticks, I guess. Wall Street doesn't seem to care that much right now, but I got to imagine capital managers like you are increasingly worried about this bad breath, in the sense that, like, hey, one of these key sticks gets removed or stumbles or breaks, it could threaten to take a lot of this down with it.
So this is a really tricky thing to talk about, because we're talking about the S&P 500 index, which has become much more dominated by 5, 6, 7, 8, 10 stocks. The NVIDIAs, Microsoft, Apple, Tesla, Amazon. And we shouldn't really be saying the market. It's not the market. It's become a handful of stocks. There's 490 other stocks too. I think I saw this stat yesterday. There's 40% of stocks are down on the year in the S&P 500. The S&P was up almost 20% before yesterday. So here's, you
can the equal weight is only up by a little bit, right? Just a couple.
Yeah, I haven't looked at it recently, but yeah. And the Russell, the small cap index, is flat or down on the year. So when we talk about the market, the S&P 500 can come down a lot, but there can be 200-300 stocks that do very well. So what is a correction, right? A correction in 2008 was that everything went down just about. A correction in 2000, which this period is a little more akin to 2000. The 2000, you had your internet bubble and everything's going to be wonderful. No, because we got this internet thing, the World Wide Web, everything's golden. And these stocks were going to the moon. But a lot of stocks were left behind. Well, what did well from 2000 to 2003? Small cap stocks, the Russell. And what did we see yesterday? Yesterday was a fascinating day. If you look at a heat map, those 7, 8, 10 stocks were down decently, and there was a lot of green on the screen. And it was the small cap stocks. The Russell was up, I want to say 2 or 3%, when the S&P was down almost 1%. So, you can get in your bunker and say this is a problem when those top 7 stocks start to falter. But this could much more be a rotational trade. So the S&P could go down 10, 20, 30%, but there could be a huge handful of other stocks that do very well. So you have to think, when you think about hedging and protecting, it's not just how much stocks do I own? Do I get short or do I use options, the traditional hedging? But it's also, how do I rotate? Do I buy more utilities? Do I buy certain real estate, some certain REITs, high dividend stocks? Do I buy small caps? So yesterday, you would have had a great day if you were in small cap stocks. You would have been up 2 or 3% in a down 1% market. So yeah, I'm very concerned because we've never really ever seen a market this dominated by such a small number of stocks. And yes, the big indexes could take a big hit, and that's something we're paying close attention to. But in 1996, December-ish, Alan Greenspan called out the market and he called it irrational exuberance. And if you go back and look at the charts and you say, okay, December 1996, here's where we stand, it looks like that. Valuations were above the Nifty 50 error. They were only, if you go back to the break before the Depression, the 1929, slightly below those levels. He had every right to say there was irrational exuberance. It took 3 years for irrational exuberance to crash, and the market pretty much doubled from when he used those words. So the point, there's a lot of points to be made here. A, this can go on a lot longer. B, you're talking about not the market, but you're talking about index names that segregate stocks. There's plenty of stocks that are cheap, that are at normal valuations or below. And, yesterday we got a little taste of it. And, so you just have to look, valuations are very high from the index level. And sure, and we're very deviated from key moving averages. So a correction just back to the 200-day moving average could be a 15-20% decline. That's a big deal. But it doesn't mean all 500 stocks are going down. And given the odd behavior of the market, you can make a case that there's going to be a good number of stocks that do just fine during that period. So, when you think about, I got to get out, think about how you want to hedge. Can I rotate? Can I try to take advantage of the situation as opposed to sitting on the sidelines and risk the irrational exuberance that goes on for 3 more years?
So you're doing a very good job of something that we mention a lot in this channel, which is we are highly likely entering an era where active management is really going to be the superior strategy to the passive management strategy that's done very well over the past 15 years or so. Yeah, hopefully. But you're making a great argument for it right now, right? Which is that, hey, there actually are there's a large percentage of stocks in the market that actually are not nearly as overvalued as potentially as the ones that are really driving the indices right now.
Right.
So there's opportunity for both shelter and appreciation potential there.
Mm-hmm.
But it's not a simple game. And one of the problems we have now versus previous times in the markets is those top 10 stocks are incredibly widely owned because of the ETF, the ETF model, which really didn't exist at this level of magnitude at previous bubbles, right? So you may be in ETFs that you wouldn't necessarily think are heavily loaded up on Apple and Microsoft and Nvidia, but they are. And so those stocks, one of the concerns about those stocks going down is the stocks themselves take huge losses, the index itself takes big losses, but then you have collateral damage across all these other ETFs that are owned, right? So again, this is where an active approach is really helpful, both for just sort of traditional hedging strategies, but also putting yourself into companies that are currently at much better valuations, right? And have less correction risk as these guys do. So I totally agree with you. And for most folks, work with a good advisor who can help put together for you a really intelligent portfolio. I will say, there is a risk to these stocks that even aren't that overvalued. simply because if those let's assume those top 10 have a real correction, they go down 20% or more and take the indices with them.
Mhm.
That's going to have an awful lot of impact on it's going to have a negative wealth effect for investors. It's going to damage a lot of companies' prospects, at least in the interim period. It is going to affect both corporate capital spending and consumer spending, and that will likely hurt all companies as well. So in some of these companies may do great, probably on a relative basis. These undervalued or these less overvalued companies will do better than the big ones if they go through a correction. My point is we just don't really know, which again is why you want an active manage approach, to be monitoring what's going on in real time and making adjustments as necessary.
Right. And I'm going to bring this up. I don't know if you wanted to talk about it, but I wrote an article on golf. And I was on the golf course, and I'm a hack, but it was a par four course. I had a great drive, which is unusual. It didn't shank into the woods. And then my second shot was beautiful. It landed on the green. So I'm what they call line two. So I'm if I putt and make in, I make a birdie, which is great. I don't get too many birdies, so that's great. And if I miss the putt and hit the second one, I'm par, which par is still very good. Uh, so, I have my two great shots, and then what they call three putt it. I missed the first one, missed the second one, finally made the third one, and I got a bogey, one over par. And it dawned on me, it's like investing. You can have the best macro. I covered 95% of that course with two great shots. I got an A plus on 95% of that course, and I got a D minus on 20 feet.
Yeah.
So here's what that analogy really hit me. It's that you can have the best macro thesis in the world, but you have to understand the short game. What's happening today, liquidity flows, technical situations, what's rotating in and out of favor, the political climate, the economy in a very short run. Like, it's easy for me to say the economy is going to decline, just the growth rate's going to decline for the next 10 years. I feel very comfortable saying that. Telling you what it's going to happen over the next quarter or two is extremely difficult. And so you have to play golf. You have to have a macro thesis to keep you grounded on kind of the broader picture and what's holding down the economy, what's propping up the economy, interest rates, inflation, the global scene, all of that stuff. But at the end of the day, a lot of it comes down to the putts, to the 5-foot putt, which counts just as much as the 200-yard drive. That they count the same, they're identical. So you have to walk this tightrope in times like today, where my macro view may not be so good, but there's nothing right now. There's certainly a lot of problems regarding market breadth, but the technical situation right now is fine. It's good. And it's crazy to say, but active advisors like us are just walking this, I'm going to use this word again, the tightrope, and very aware of potential problems, and very aware of what happens to the stock market, we would start selling, hedging, rotating, buying more bonds, whatever it may be. You have to have those life jackets ready to go and in place, but appreciate that there's a lot of liquidity. Sentiment is still very good. The narrative behind AI is alive and well. What it's going to do for NVIDIA and Microsoft and any company that uses the word AI 42 times in their earnings conference. And that's the market we have to be in. We can't say, okay, here's what's going to happen over the next 10 years. We're going to invest for that and shut our eyes and go to bed, and we'll wake up 10 years and see what happened. That's not our jobs.
Right. Yeah, as Lance says, you guys have to provide a good return every year, or you just start losing clients.
Right. We have to make those 5-10-foot putts.
Yeah. All right. So I got to land the plane here, given our commitments. But real quick, I was going to ask you about AI. We're really running out of time, but I had an interview a few weeks ago with Fred Hickey from the High Tech Strategist, who was very vocal in saying, look, we're not seeing the returns from the investment in generative AI to validate the current spend that's going on there, and that's he's seeing that as an increasingly the pushback that's he sees starting to mount against generative AI, right? Since he was on, I'm now seeing that narrative in more and more headlines, where it's basically saying like, look, it's the show me the money stage now of AI investing, right? And we could probably talk a lot about that, and we'll save that for a different another video. But my point there is, I think that's another potential sentiment shift candidate like the jobs market, where AI is the future, AI is the next big revolution. That's the narrative right now. That could shift pretty quickly to this huge AI spend is not paying off for us in the short term. The benefits of this, while maybe real, are going to be a lot longer in arriving than we initially thought. And then, if that indeed does lead to companies saying, okay, well, look, I'm going to slow my roll in terms of the gargantuan amounts of money I'm spending on this, that could then start to hit the earnings and the forecasts for NVIDIA, and that could start the chain reaction.
Yeah, absolutely. And, go back 25 years to the internet. That was the greatest thing ever, right? That was going to increase productivity immensely. And it didn't. Productivity growth in this country has declined since before 2000, but from 2000 on, despite the internet. And there are certainly productive, very productive things that have come from the internet. There's no questioning it, but there's a lot of unproductive things as well. And, from a broad macroeconomic base, productivity for the whole economy has decreased. Productivity growth has decreased for the last 25 years. So will AI flip that trend and make it positive? We'll see, but there's no guarantee that that's going to happen. And you're right that all these, again, think about NVIDIA. Their margins are massive. So high margins invite competition. So even if making these GPU chips is the wave of the future, they're not going to be doing it by themselves. Their margins are going to get cut significantly because there's going to be a lot of new entrants to that market. That's a free lunch that they're not going to get for much longer. And again, they're 6-7% of the market. When that gets repriced, whether that's tomorrow or whether that's next year, it will have an effect on the S&P 500.
All right. So a lot more we could say about that, but I mean, I think we agree that that's one of the candidates out there where the market could wake up at one point and say, hey, we have been way too optimistic about this and we need to readjust. All right. So real quick, we won't do it this time, but every week Lance and I kind of pull up the S&P and show it relative to its daily moving averages and the MACD and the RSI and whatnot. But you said earlier, technically, not a lot to worry about with this market right now. I assume you're sort of saying that like, hey, it's still in a bull channel. There's nothing too worrisome about the technicals. Lance has been saying for many weeks that we've been in overbought territory, and likely one of two things is going to happen. Either there's going to be a 5 to 10% correction, depending upon which moving average line we end up correcting down towards, or this could just churn sideways for a long time and let the moving averages catch up to it.
Right.
Just real quick for folks, are we still in overbought territory as you see it right now?
So the S&P was down 50-ish yesterday. It was up 50 the day before. We're still above the 20-day moving average. The MACD is just kind of dancing around, flipping. The two lines keep flipping, but it's not really declining. The RSI is high. We're overbought. We're about two Bollinger Bands, two standard deviations above the 20-day moving average. So, again, we're just kind of following this kind of tight channel upward. And, when we break the 20-day moving average, that's something to keep an eye on. Then, like you said, the 50, 100, 200. This is it looks very similar to what we've seen earlier this year and at late in October, November, December 2023. It's a very similar market, and it can just keep taking the stairs up at its own leisurely pace. It can correct down, to the 20, to the 50, to the 200, who knows where. But again, you can also get rid of overbought by just going nowhere. So, that's why just active management and paying very close attention to technicals is, especially in this kind of market, extremely important.
Okay. All right. So last major question before we wrap up, trades. Have you guys made any notable trades over the past week?
We haven't done anything, I don't think, in 2 weeks. We're very happy with our portfolios now. They're doing what they're supposed to be doing. Yesterday, the market was down a decent amount. We were down very slightly. Our bonds did very well. Over half our stocks were up yesterday. So we're comfortable. We're always talking. Lance and I were going back and forth last night on, potential adjustments. Some of this rotation we were just talking about. Is it time to add a little bit more small cap? Do we want to add a little more duration to the bond trade? So we're having, just because we're not trading doesn't mean we're not having conversations and throwing out ideas and debating and fighting at times about what to do. But we'll see. Maybe next week will be the week we make a trade.
All right, and on your bond trade, as you mentioned, RIA has had the thesis that interest rates are going to have to come down for all the reasons you've already said in this discussion. And one of the ways in which you're going to play that is by owning long duration U.S. Treasury bonds and riding the repricing as interest rates go down, the bond prices should go up. It hasn't been the world's most profitable trade up to now, but you guys haven't been worried because this wasn't a short-term trade for you. This was more of a, hey, we know this tipping point is going to happen at some point. We feel confident with it. I guess I'll just ask, since you're here, because folks want me to, has anything changed that thesis in any material way you want to share with folks? And if the answer is no, still the same it's always been, are you contemplating adding more to it, or have you taken your position and you're just going to let that one ride?
No, we're certainly, so there's two ways. We can actually buy more bonds, or we can sell some of our shorter duration, shorter maturity bonds and use those proceeds to buy longer duration bonds. So again, Lance and I were going back and forth last night. He wouldn't let me go to bed on texting me about that particular topic. When do we want to do that? And again, with bonds too, we're looking at the technicals. The difference between stocks and bonds is bonds tend to be much more fundamental. If you look at a scatter plot of inflation expectations, surveyed inflation versus bond yields, it's extremely tight. So if you tell me where inflation is going to be a year from now, 6 months from now, I can give you a pretty good guess on where bond yields are going to be. So technicals certainly matter for bonds, but fundamentals also matter. So, I still love the trade. I still think it's a great trade. It got held up, I think, in large part because of shelter prices. They kept inflation sticky for that last 6 months, which we just did not anticipate. But we're starting to see inflation starting to head back lower now, which should hold up well for bonds.
Okay. All right. Well, look, Michael, I'll let you have the last word here in just a quick second. Just two quick things for folks. If you've enjoyed having Michael on, pinch hitting for Lance and frankly doing a much better job than that Lance guy does, please let him know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. A reminder, we're only 2,000 subscribers away from the 100,000 subscriber milestone on this channel. So if you're one of the 50,000-ish people watching this who hasn't subscribed yet, please do. It'll really help us out. Let's see. We've talked about active management an awful lot here. So just a reminder, Unless you have a very well demonstrated track record of being a successful DIY investor, highly recommend that the folks watching this video navigate this increasingly uncertain market environment under the guidance of a good professional financial advisor who takes into account all the macro issues that Michael and I have been talking about. When you layer those requirements on top of each other, they got to be good, a professional who's good, who takes into account all these macro issues. The universe actually shrinks an awful lot.
Right.
There's a lot of old school set it and forget it advisors out there that I don't think you want to be working with in this environment. So if you've got a good one, like I mentioned, who's also coming up with a personalized plan for you and executing it for you, fantastic. You should stick with them. But if you don't, if you'd like a second opinion from one who does, maybe even Michael and Lance and their team there at RIA, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just go to thoughtfulmoney.com, fill out the short form there, only takes you a couple seconds. These consultations are free. There's no commitment to work with these guys. It's just a very admirable public service they offer to help as many people position as prudently as possible today for what might be coming tomorrow. And if you're there at thoughtfulmoney.com, consider just clicking the newsletter link right there at the top of the page and sign up for our free newsletter. This week's Macro Pass service for our premium newsletter subscribers is Ted Oakley's market outlook for Q3. It's a really good one, so you guys should consider getting that. All right, Michael, well, look, we're back to you. We'll let you have the last word here. Any parting bits of counsel for today's investors kind of scratching their heads about what's going on, maybe a little bit jittery about where things might be headed?
I think be the eagle. I could come on here and make a great bullish case. I could come on here and make a great bearish case. What we do all the time and what's very important is just be the eagle, be above it all. Understand the bull case, understand the bear case, pay close attention to what the market is telling you. That's technicals, that's sentiment, that's narrative. And just don't get caught up in one mindset or another. Just be open that a lot can happen from here, positive, negative, and trade the market as it comes to you. Don't trade a market that you think is going to be there in a year. You have to be, like, we've discussed, very active. So,
all right.
2 cents.
Great advice. You're not wearing your RIA shirt, which Lance wears every week on this, but to remind folks, RIA's logo is an eagle because they want to be up there looking at everything and adopting a bullish or bearish stance as is called for, as opposed to just philosophically being a bull or being a bear.
Right. Correct. And
all right, go ahead.
No, just there's a lot of great stuff out there, and I read a lot of bullish stuff, a lot of bearish stuff, and what I find is that they can help me. They help me either cement my views, or they say, you know what, I really need to think more about this or that. So read everything. Read the bulls, read the bears, and please read our eagles, our eagle articles.
All right. Well, Michael, look, great discussion as always. We need to kick Lance out of the rotation more often to get you on here. Thanks so much for coming on, especially with the loss in your family and being on the road and juggling all this. So always great talking to my friend, but a special thanks this week.
My pleasure. Thanks, Adam.
All right. And everybody else, thanks so much for watching.